Let's talk money. Whether you're thinking of buying your first home or your next investment, financing can break or make your deal. With us today, we have an amazing loan officer who's going to simplify today's current interest rates.
Sal Ortiz is also going to explain non-QM loans, what they are, who they're for, and why they've become such a hot topic, especially here in Southern California. If you've ever been confused about lending, this topic is for you.
I'm Isabel Machrone.
And I'm Rosa Ortiz.
We're real estate professionals in Southern California.
And each week we break down what sellers and buyers really need to know right now.
This is Let's Talk SoCal Real Estate. Joining us today, we have Sal Ortiz with Easy Funding's Home Loans. And if the last name sounds familiar, he is Rosa's husband.
He sure is. Welcome to our podcast.
Thank you. Thank you for having me.
Tell us a little bit about yourself and how you got started in loans and with Easy Funding.
Wow. Quite a story, actually. I kind of fell into the mortgage business. I was transitioning from being a sales manager, started selling cars. And about my first weekend, I meet a real estate agent, believe it or not, helped her with her vehicle, sold her a brand new Pathfinder at the time. And she was so happy with me. She's like, you know what? You're in the wrong business. And I'm like, okay. We finished our transaction. And then afterwards, I didn't think nothing of it. A couple of days later, she calls me and she tells me, hey, I have a lunch appointment with you. And as you know me, I love to eat. So you mentioned lunch, I'm there. And she's like, I got a mortgage job for you. At the time, I was like, what is mortgage? Right. She basically introduced me to a mortgage broker. He trained me, got me started. She sent me all her clients for quite a bit. She was a top producer in the area. I still see her here and there on Facebook. At the time, she was quite busy. And she used my services being Spanish speaking.
What an amazing mentor to have when you start, somebody with that much business.
Yes. And then she introduced to all her buddies at her office. And I was kind of like the in-house lender without being the in-house lender kind of thing. So it was pretty cool. Just kind of fell into it. Been in it for about 21 years now. Had long hair when I started and look at me now.
That's great.
So can you start off by just telling us what are the rates at right now? What's going on with interest rates and what causes them to go up and down?
So one of the things, tapping into rates, we have so many loan programs available that it's hard to just kind of throw rates out there, but rates go up and down on a normal basis, depending on the jobs report, inflation. There's different factors involved, of course.
What's the connection with the job report?
So basically, if there's less jobs, they tend to lower rates a little bit. And if there's more jobs, they kind of try to push rates up a little bit. If you want really good detail on that stuff, is obviously an economist will be the person to contact, right? To dig in. We kind of just generalize it. We just kind of keep it towards how it affects rates, right? And the reality of it is kind of what I shared earlier, is that if you have job losses, that usually makes rates better. Okay. If the jobs report is way up, then it kind of holds rates. It doesn't help rates much. One of the things for us is usually I have a lot of families that all the time check in, and every time they hear for example, when the Fed drops rates, get excited. They think that it's automatic. It's automatic for short-term loans. So short-term loans get that immediate effect, okay? So say, when it drops like 0.5 or whatnot, on the mortgage end, it takes time for it to take the steps, is what I call it, so we can see the benefit, right? So it kind of depends on what else is going on. In this case here, most recently, we were looking very good on rates. They're kind of coming down. Things were looking in our favor. And then, of course, this whole Iran thing happened, and it kind of just pushed the rates up a little bit. The reality of it right now with rates, what's happening, that's a good thing, is that they're not spiking up and down. They're still kind of holding. I see that as a great pattern for what's coming in the future. I think that rates are actually going to definitely start coming down because of it. Otherwise, I think they would have spiked up quite a bit, and it would have hurt a lot of families that are trying to purchase or refinance a home right now.
I know you do all types of loans, Sal, but today we're going to focus on non-QM loans. Can you tell us what exactly is a non-QM loan and how are they different from the traditional loans?
So the non-QM loans are basically created to help all those that don't fit into what we call the lending box, right? So for all those families that are W-2 employees, file their taxes, do all the normal stuff, the regular stuff, those are all fall into our Fannie Mae, Freddie Mac, Ginnie Mae loans, which is basically your conventionals and your government loans, right? Now, our non-QMs are mostly designed for families that are self-employed. One of the things with self-employed families a lot of times is they make great money, and they get taxed a little harder, right? There's even families that we've helped with even 1 year of being self-employed with our products. So there's great opportunities for self-employed families. And then the non-QM products also help a lot of families with buying investment properties. And with those, when you get into that bucket, you don't have to be self-employed, which is a great thing. So all those families that are B2 employed and that want to have the desire and they have the assets to actually purchase property and they don't qualify on paper, it's a great opportunity because they protect you to a point where you're buying a property that actually rent rolls. So as long as the rent rolls, we can definitely make it happen. There's products that we use a lot of time for like the investment properties that with a 25% down, they don't even require reserves. A lot of time with loans, especially if you're buying investment properties, they require reserves anywhere from 6 months to 12 months. Reserves are used for families, basically, especially when you're renting a property, is that if the property, the family that you rent the property to stops making a payment, you have enough money to cover that payment for the 6-month period or 12-month period, right?
I have friends and family that are gig workers or in the entertainment business, and it's very difficult, especially when it comes to home loans, to get qualified. That non-QM loans is something that they can turn to.
No, it's a great opportunity for all these families. Or even on the government side, we're tapping into like our what I call is like a non-QM FHA for like the self-employed families. All they need is a 3.5% down. They don't need a 20% down. They don't need to have an over 700 score. Even with a 600 score, we're able to help families. There's a lot of families that work for another family member, possibly. So what I see a lot of, depending on communities, right? But I see a lot of it in the Hispanic community where they work for, say, they pay them half cash, half W-2. So for instance, like just say they make $100,000 a year, and on paper they're only showing 50. We have a VOE program that allows them that even with a 3.5% down, they can actually buy their home. So it's a great opportunity for families like such, that they can actually buy what they qualify for. One of the things we do, of course, is we'll ask for bank statements for a few months to make sure that that money is there, that the assets are there, and everything else involved to make sure that they qualify.
So that brings me to the next question, which is these types of loans are more popular now, and that's because there's more ways of people getting paid in their jobs. And you just mentioned a perfect scenario where somebody might get paid half cash and half on payroll. And before they couldn't count that income. And now with this program, it's amazing that all the income can be counted. Somebody who makes just all cash qualify for this income, or they still have to provide some sort of tax return?
Usually what I specialize in with these loans is no income taxes. We don't need income taxes at all. So either you fall in the bucket of we can verify your employment through a verification process, or you're self-employed for your cash question, right? So if you're getting paid cash completely, most likely you fall into the bucket of you're self-employed. And at that point in time, we take those steps, right? So even with a profit and loss statement, okay, you can actually buy a home with this product with 3.5% down. And all you need is a 600 credit score, okay? Nothing crazy. No, again, to me, it's amazing that it's out there. It's a great opportunity, and it's just a lot of people think that stuff like that is hard. They think if it's not hard, it's not obtainable, and it's quite the opposite. There's opportunity out there, and there's families taking advantage of it.
Just a matter of sitting down with a mortgage lender like yourself and getting that free consultation and seeing where they're at.
Reason why we're doing this is have people listen and learn of the different opportunities that they didn't know existed.
They actually do it. And it's amazing because they think it's hard, and the reality of it is if you're taking the steps of qualifying on paper, all we're really asking you for is to verify what's your actual income. We don't even ask for tax returns, okay? Only if you have rental properties and if you're doing a papered loan, then we need those tax returns in order to see how you're writing off you're showing income on those rental properties to make sure you qualify for the next property. So a lot of times families now, even with what I'm tapping into now, is they prefer to just go the non-QM route and not worry about showing all those tax returns and everything else involved if they're buying another investment property. So with these non-QM loans, I'm sorry if I'm going too fast, I apologize. I get excited about loans, right? So you can do 5+ properties on the rental side. So it's pretty neat.
What is the
Abbreviation for QM?
Non-qualified mortgage. They are one of the things that I see as a great opportunity with these type of loans. The difference before was like a 2% rate difference between the two. Okay. Now they're so good at it now that, say, to give you an example, family buying with 20% down, rates are in the sixes. Family B buying non-QM, 20% down. They're in the sixes. You
So
know,
the gap is very close.
it's
Now it's
very
more, it just opened up the
yes.
doors to many more buyers.
Many more families are able to buy their dream home, really the American dream, right? Of owning their own home. And not only that, the opportunity for them to even after they buy that home is to buy more homes. Right now, I have a
Mm-hmm.
family that I just helped. I helped them like 3 months ago. They were so scared that they're doing a non-QM loan.
Mm-hmm.
And I thought I kept having that counseling talk with them every day. I said, look, trust the process. I've been doing this for many years. You're going to be fine. And they're
Yeah.
like, just can't believe you're not asking me for my tax return. And this is a conversation that I had with, it was funny because I would talk husband in the morning, wife at evening, and they would hit me twice a day kind of thing, right? This is like for a 30-day period. So you figure that's about 60 conversations that I had trying to
Yeah.
just let them know that it's okay. It's okay.
Yeah,
It's
they
okay, right?
couldn't believe it, how good it was.
How easy it was,
Yeah.
right? They're like, "That you're not gonna ask me for nothing else." No, this is all I need. I usually give families a list, 1, 2, 3, whatever it is, right? So, depending on the family situation, the list kinda changes a little bit, right? And now here fast forward 3 months later, 2, 3 months later, now wife, calls me yesterday, she's like, "Hey, now I wanna buy a investment property."
Wow.
And I'm like, "What
That's
happened to all the fear?" And she's like, "Oh, you took all that away. We believe you now,
that's
Sal."
great.
I'm like,
That's
"Okay."
so awesome.
So
That's amazing because that's totally what we've talked about on our first episode, Ultimate Buyer's Guide. And we definitely covered that affordability is really how much monthly payment can you afford,
Exactly.
does it make
right?
sense? And this is the thing too, okay? Let me throw this in there. A lot of families think that when they buy a home, it's forever, right? The average American keeps a home for 5 years, right? That still exists today. Number 2 is the average American refinances out of their loan in 2 years. So if that payment scares you, the reality of it is on most loans, like let me give you an example, like on non-QM loans, you just got to keep the loans 6 payments. So as soon as you make 6 payments, you can actually start visiting options for yourself. If say for instance, let's just talk about it. Rates are in the sixes now. 6 months from now, this whole war goes away. Everything changes. We're supposed to get a new Fed chair, right? All that benefits the families. That's the whole purpose, right? Rates come down, they go down a percent. For a family that has an $800,000 loan, that's about $750 that their payment's going to drop. Why wouldn't they take advantage of that, right?
And I've personally experienced that call you make to because you keep in touch with all your past clients and you make that call. Hey, this is a good time to refinance because it just makes sense for them or you're saving them anywhere from $500 to $700 a month. It's just a beautiful call to make.
No, it makes me feel good. That's the reason why I sleep like a rock, guys.
What are the common ways a borrower can qualify?
So qualifying purposes, okay. So for non-QM loans, most of these loans are created for self-employed families. There's options, right? Let me just talk about the easiest option right now, and then we'll take the next step on the second one. Is that okay? So the easiest, fastest loan that we do that we started this whole thing with is for families that are self-employed using their bank statements. We either use 12 months to qualify or 24 months, right? What they do is they average the deposits that you do on a monthly basis. And then it becomes obviously for the 12 months, it becomes your yearly income. And that's how we get you qualified. So
That
it's all
makes
based
sense.
on your deposits. Pretty cool, amazing loan. All you need is a 10% down if you have a credit score above 740. We have other products with a lesser credit score, but obviously, the rate won't be in the sixes like I was talking about earlier. So I want to make sure I share that. But the opportunities are out there. I say for that product, if you don't have a 740, it's better to do like a 20% down. That way you can kind of still get your home. And again, tapping into what I shared before, you can always refinance after your 6 payments.
What's
So
the
Okay.
minimum score again? The minimum?
the minimum credit score for those is like a 680, 660. So it's all based on risk. So if you got a family that is not producing, you know, tax returns and everything else, and then on top of that, you have the lower credit score, and then on top of that, you have a lower down payment, a lesser down payment that, it doesn't look as
Yeah.
pretty as somebody that has a 740, 20% down.
Yeah. It's really helping families, not giving it away, but allowing the opportunity.
And
Great
again, I'll
opportunity. Yes.
repeat this part because we did talk about this with our first lender we had on our podcast is don't shy away if you don't have that 680 credit score because Sal can help you have a game plan to increase that credit score with his resources as well.
We've done that quite a bit. I think just doing that, um, with families that weren't necessarily, this is the thing. Families think that they need to be 100% ready to apply,
Exactly. That's my point.
and you don't. All right. If that desire is in you, take it. Do an application, see where you're at. I rather know. And then this is the thing that if you do not qualify, one of the things that I do for families is I'll give you the steps to get you qualified. And depending on where you're at, I've had families where we get them qualified in a month. They thought they couldn't buy anything for years because they were so scared to see how their credit was or how their
Yeah.
financial situation actually was on paper. A lot of us have fears, right?
The
And that's
fear
a
of the unknown, right?
Yeah.
100%, 100%. So for me, going from years of wondering to in 1 month, you can buy your house. It's amazing, right? Now, of course, then we have families that are a little more beat up because life happens, right? Life happens to everyone. Anywhere from 3 to 6 months, following a game plan, we get them into a home. So it's a great opportunity for sure.
And even 3 to 6 months, it doesn't seem like a long time nowadays.
It goes,
Yeah.
it goes very quick.
Can you give us an example? The rates now are very close.
The rates are basically about a quarter difference in rates.
And
Okay,
that's
great.
more of a person with that 740 or above.
740 or above, yes.
When you're younger, you really don't pay attention to your credit score until you want to buy a car or buy a house. That was instilled by my parents. You need to have 720 credit score.
Instilled in us in a young age, then that can be our goal in life. Maintaining that non-QM loans. What are the terms? Is it a fixed rate for 30-year loan or what?
Great question. Great question. What do you want?
Okay, so they have a choice.
So yeah, you definitely have a choice. You can do a 30-year fixed, right? You can do ARM loans too. A lot of many moons ago, these came with a balloon payment, right? I don't know if you two have heard about that before.
Yes.
They no longer have that. I mean, for you to be able to keep a loan for 6 payments and there's no balloon payment, that's amazing.
That
Just
is
a few
great.
years back, it was a year. You had to keep the loan for a year, no longer. So the opportunity is really there for families to make moves. I mean, it just opens more doors, in my opinion, right? So you can do 30-year fixed, just kind of go back over it, 30-year fixed, and you can do ARM loans anywhere from 1, 3, 5, 7 years. But usually this is a thing with non-QM loans. What I've seen, my experience, I'd rather lock in on a 30-year and just kind of not worry.
I was just
Than
going to say that most people will choose a 30-year, right?
I would say that 95% of families buying are locking into a 30-year loan.
They want that security.
Security. Everybody, who doesn't want security, right?
Right. Mhm.
Right. Can you explain what an ARM loan is?
An ARM loan, basically, you're buying when you do a loan, okay, you're buying something. You're buying a contract for 30 years or for 15 years, or you're buying an ARM loan for 5 years, right? For 5 years, say for instance, your interest rate is X, right? So X is going to be exactly tied in. Principal and interest not going to change for the next 5 years. After the 5 years, what it does is it becomes a floating loan, right? So it floats depending on what the market does. If the
Okay.
market goes up, kind of what we're tapping into earlier. If the market's up, then that rate X is going to turn into a Z.
And our
And that-
audience may be asking, like, who wants an ARM loan? Well, there are a lot of people that want that ARM loan because they have a plan, right? They have you know what, I don't plan to stay in this house for more than 4 years. And so that makes sense. And that's where you as a lender will say, well, this is what I recommend.
So originally, those loans were created for like doctors and people that don't stay in a specific area for a very long time. It's basically where the ARM loans are originated from many moons ago, right? So, and a lot of families, they understand the process. Even investors, I'll have, in the past, I've had families that they buy a home that's not the best looking. They'll fix it up, live in it for 2 years, and then they're going to their next home. And a lot of times, when you're now tapping into the conventional loans, on the ARM loans, you're going to get a little bit better rate. So they take advantage of that slight difference in rates, where it benefits the family a little bit more. It depends on what the market is doing. That's what they're buying into, because banks are investing in you. That number one is make your payment, and number two, you're going to keep that loan for a specific amount of time.
Is there any prepayment penalties or anything?
So with the loans that I originate, I don't tie that into the products or the home loans, I should say. But they do exist. They're out there. So people got to be careful on what they're getting themselves into. Sometimes if something is very shiny, just kind of look into it a little bit more as to why, right?
That's interesting. I didn't know that was like something that
Yes,
is
it exists.
optional on your end, on the mortgage lender's end, to implement that.
So it all starts from the top. One of the things here at Easy Fundings, I mean, they take great care of our families. They want to make sure that we're providing the best service for them. There's even loans that exist out there that we don't do because of that. They want to protect our
Okay.
families. Okay, so a lot of times, sometimes I'll have some of my agents call me and ask me, "Hey, I heard this, great product. It's the, 3% down, and I'm like, look, we don't participate in that one because of back end reasons that we don't believe in. Sure, we're protecting our families, not just providing them a home loan because that family is trusting us. We want to make sure we invest in them.
What are the biggest misconceptions about the non-QM loans?
That they're basically super high interest rates and all these loans that, that they're not fixed is what I hear a lot too. Oh, I heard that these, and then the other, I'm thinking of Isabel here, balloon. It has a balloon payment. And many years ago, they did. They're very aggressive, and now, obviously, as time has progressed, they're getting aggressive a different way, where they're being more beneficial for families that are self-employed. We're getting a big influx of families that are leaning towards being self-employed than actually working for someone else. So, I mean, I think if you get yourself informed and you follow the steps and you make your payments and everything else, you have nothing to worry about.
If I qualify right now for a non QM loan, but I'm going to get a job next month and I'm going to have W-2s, should I wait and do a conventional loan?
So this is the thing, right? If you're self-employed, you've been self-employed for about a year at a minimum, or even longer, even better, right? There's Unless your business is struggling, then I would recommend go ahead and get yourself a W-2 job and everything else. If you've been self-employed for over a period of 6 months, you're gonna have to wait either a year to 2 years on a W-2 income to actually qualify for a home. So this is the thing. We know what the interest rates are today be 2 years from now. Same thing with property values. One of the things I tell families is this, is that we know exactly that interest rates are going to fluctuate little here and there. Lately, they've been steady, which is amazing to me. On this end of the business, it's great because they're not spiking up or down. Obviously, everybody likes a lower interest rate when we get them, right? Spiking up, which that scares people and makes people not want to do anything. They don't want to buy, right? So they're slowly up and down, right? So it's great. Now, number two is that if you're going to go ahead and if you're self-employed and you can buy now, that means you have a 20% down. Why wouldn't you? If you can afford the payment, let's talk about the payment. If you can afford the payment, buy your home. We can't control the interest rate, but one of the things that we do know and seen for the last 10 years, and I can ask you this as real estate agents, is property values have gone down or up the last
Steady or going up?
every year, right? Every year. And this is the thing I tell families is depending on where you're buying, you're going to miss out on either 50 to 100,000 in equity a year, right? Well, I see it, right? And you see it as real estate agents, even a property, depending on where it's at. I hear from a lot of the agents is location.
Yeah, it definitely probably is based on the counties that you're in.
Certain pockets and neighborhoods are.
Especially here, Southern California. Come on.
We can't emphasize enough for the consumer to meet, have that consultation, because this is where they break it down, what fits, they analyze them, they, go over the loan products that best suit their needs. And then as mortgage professionals, you are the ones that help the consumer make a decision.
So 100%. One of the things is that our goal is to present opportunities to families. Now, back to the question, right? If you can buy now conventional versus non-QM, the gap is so close on the interest rates,
Mhm.
right? That if you're self-employed and you can go either conventional or non-QM, you're like basically there.
Why wait?
Why wait?
We touched on they could refinance if they make 6 payments and the rates drop, say, from here to September or October. You will get in contact with them and let them know if it's a good idea to refinance, if it makes sense for them.
It has, in my case, what's kept me in the business is taking care of my clients. I mean, like I said, when I started 21 years ago, I had hair and everything else. Now hair's gone, but at least the families are still here. Kidding. But the goal is there has to be a true benefit for me to help. I don't want to just do a loan to do a loan. Okay.
That's good to know.
What's the typical timeline on getting approved for one of these loans?
On non-QMs, usually we close anywhere from 15 to 21 days. We prep them up front.
Okay.
We treat them like all our other loans, our conventional loans or FHA loans. And that's the reason why we get the result we do.
And then I don't know if this makes sense, but I'll ask it. Who is
Sure.
not a good fit for a non-QM loan?
That actually is a good question.
No, that is a great question. There's a lot of family that doesn't benefit them to go non-QM. Number one, they're not self-employed, right? that automatically cuts you. Credit score is below 680 or 660, and that's another thing there. And then the other part, of course, is we look at risk, right? So there's once we ask for those 12 months bank statements, if we see too many, NSF, not sufficient funds.
Oh,
So that's the reason why usually on some of these loans we ask for what we ask for is we want to make sure that we're providing a loan for a family. It's going to be something that we're actually, giving them something that's sound, and we're not putting that family into something that's going to be detrimental for them in anywhere from 3 to 6 months, right? We want to make sure that we're helping.
good.
That's wonderful.
What's the biggest mistake you see buyers make when trying to qualify for a non-QM loan?
The number one reason is don't go buy a car. Please, the cars are always going to be on sale. There's always going to be a holiday.
And there's enormous inventory of cars.
Yes, like they're everywhere, right? I mean, the worst one I ever had, I call this family, hey, you're clear to close. There's a big difference between saying, hey, you're clear to close and hey, you're funded, right or wrong, right?
Right, right.
So we're clear to close. They get so happy. I don't know why that weekend he decides to go buy himself a truck, right? And the salesman at this dealership tells him that, hey, don't worry, it doesn't come out of your credit report. Yes, it does.
He's a salesman trying to sell him a car.
As soon as you run your credit, guess what? The mortgage company is getting a ding, and then guess who's getting a call? This guy, right? If I'm doing your loan. So I wake up to a message to, it even said on there, the truck product and everything. I was like, no, man, there's no way. Call, doesn't answer, call again, doesn't answer, call his wife. Hey, please tell me that this didn't happen. And the first answer I get is from her is, how do you know?
That's what I was
Right?
just going to say. Great point. You guys know everything while you're in that process.
While you're in the
Because you're
process
getting
of
dinged, like you said, the bank wants to know if the buyer is getting himself into debt while trying to obtain this loan.
Yeah.
100%. So this is a thing, something that didn't exist in the past. Now the way the bureaus work, it's like instant. I've even had it where families get excited, and what happens? They go buy a refrigerator on credit, and depending on that family, if that debt ratio is right there, we're in the line,
Like
especially
barely
here in
making
Southern
it.
California, right? I had one family years back where she had to actually pay off that refrigerator so we can close on her loan because they did two things. This is the thing, okay, as well. And I'm sorry if I'm getting a little long-winded here, but just while we're at it, right?
These
Number
these
it drop,
scenarios help.
well, number one, it drops your credit score. People don't think of that, right? So if you have a borderline credit, say for instance, you're doing a non-QM loan and you have a 740 credit score and you buy yourself a truck, right? Guess how much that drops your credit score?
Like, is it kind of like driving it off the lot, like 15% maybe?
No,
Like 20 points?
it can be up to 100 points. You're taking on a negative debt, right? So guess what? You you just put yourself completely out. Now, am I exact on the points? I'm not exact. I'm generalizing, right?
Mm-hmm.
Maybe exaggerating a little bit, which is it's a good thing. Number two is that's people. Number one, they don't think about. They don't think about their credit. They think, "Oh, my credit score is this. No, it's not in that bucket no more. You just dropped it, right? Two is now you took on a debt, right? So now, for instance, if on that loan, if you're just on the border on qualifying income wise, guess what? Now you added debt to it. Now you probably you can't afford that house on paper anymore. You just push yourself out completely.
That really is a total bummer. But when you said wife, that reminded me of a question that I wanted to ask. So applying for the non-QM loan, both are going on the loan. How does that work?
Or is it only the person that has the business?
So, all right, let's
When
tackle
it's
it
a
this
husband
way.
and wife.
So
Yeah,
you have a
because-
husband and wife, right?
And they're both self-employed.
Yeah, you can do it either way. You can do both of them together, being self-employed, depending on how they're. Okay, so I'm gonna dig a little bit here. Okay, so if they're self-employed and the business name is together, and if they're 50-50 partners in the business, right? Usually most marriages are, they'll be 50-50, right? So we'll need both of them to show all their income if they need it. So and how do we come up with the income? We either do the bank statements or we do a profit and loss statement. A CPA has to write it out, right? So the CPA is going to say, oh, 100% of the business is this income. So we need
Mhm.
both of them, right?
Yeah.
Now, for instance, I've had instances where only one is self-employed, right? The husband or the
Mhm.
wife is self-employed, and we do a self-employed loan for the family member that's self-employed, and then the other family member, of course, just goes on title. They won't be on the loan, but they'll be on the home, right?
How about if the two have two different businesses? they can still qualify together for that non-QM on the loan, right?
100%.
Okay.
100%. Yes.
Okay.
Or if we just need one of the businesses, we just use the one. We don't need all of them.
Yeah, because sometimes they can be self-employed. They're not working under the same LLC. They might have two separate LLCs or corporations.
I mean, it just depends on what we need. Like, so we can kind of dig into it further, but what we need is what we use. And what we don't, we just kind of leave it alone. We don't need to dig into it like we would if we're doing a conventional loan.
Yeah.
Regardless.
The non-QMs are each family is very unique situations.
I agree with you 100%. I think that I would call it more tailored to the family, which I think is amazing.
Okay. So what is something most realtors don't understand about non-QM loans?
A lot of realtors don't understand that there's no DU. There's no desktop underwriter for a non-QM loan. A lot of times, I shouldn't say a lot of times, I would say 99% of the time that we give a family a pre-approval letter and they make an offer, and the next thing I'm getting from the listing agent is, where's DU or where's the LP?
It goes back to we don't know what we don't know. So thank you for
100%
educating us on that.
So that would be more of a conditional loan approval, right? So that's why an actual underwriter took the time and dug into the income, assets, you name it, right? And we have a complete credit profile for that family. And then we have conditions. But again, it goes back to who you have as a lending partner and how good they are at their business, where they can actually give you something solid where we know it's going to close, right? One of the things I usually do for this product here is I'll actually call the listing agent myself and let them know that I've been in lending, just to kind of help them understand that I understand the process. I've been doing non-QMs for years. And the process is very simple. Is we have the assets, we have the credit, and we have a family that's willing to buy, and we're moving forward.
You are like the live DU, calling them live. That's actually good because that ensures them. You give them that it's security, and like you're guaranteeing you've checked everything on that buyer, and you're giving them that like green light. This loan is going to close.
Basically, I'm letting them know that trust me, I'm gonna be able to get this done.
Is there anything we didn't cover, Sal, that you think is important for the consumers for this non-QM?
I would say that to give yourself an opportunity to see if you're self-employed, if you have that desire to buy a house, definitely give yourself that opportunity to visit options. Okay. I share two different ways to get approved, even with as low as a 3.5% down, which to me is an amazing opportunity because 3.5% down, it's like doing like a regular FHA loan. It's super low. The opportunity is there. Don't be scared. Visit those options, That's basically it. It's simple.
The biggest nugget for me, or the takeaway, was that the difference in the rates is just very,
very close. It just opens up the doors for those people that really don't think they can do this.
And one of the things that we didn't touch on, and I'll just throw this out there, okay? I'm not a CPA or by any means, but look at the opportunity you're giving yourself as a family to buy a home. Now you have another write-off as a self-employed family, which is that interest rate.
We did cover that in our buyers episode, but thank you for bringing that up.
I love the opportunity that is out there, and it truly is well-connected realtors and lenders in really helping families reach their goals.
We love it. How can people reach you, Sal? What is the best way to contact you if they have any questions about this non-QM loan or any other type of loan?
So one of the best ways is text me at 310-902-7451.
You're on social media also, and
I'm everywhere. I think I have all the avenues covered. I'm Facebook, Instagram. You just type in my name, Salvador. I go by Sal, but my real name is Salvador Ortiz. I think on some I have junior because I'm actually a junior, and my dad was the main one, right? So, but yeah, they can find me on Facebook, Instagram. I do TikTok too as well.
Well, thank you for being here with us and covering this topic that is a very popular and important loan product.
And I've learned a lot from it as well. So thank you.
Thank you for the opportunity.
We'll let you get back to work. Okay? Thank you.
Thanks for listening. Let's talk SoCal real estate.
If this episode helped you, be sure to subscribe, follow, and share it. And tune in for new episodes wherever you listen to podcasts.
And if you're thinking of buying or selling in Southern California,
click the link in the show notes for your free buyer's guide And if you have any questions, email us. We'd love to answer them all on the upcoming episodes.
Isabel Machrone and Rosa Ortiz are licensed real estate agents with Keller Williams College Park. Each Keller Williams office is independently owned and operated.
The information shared in this podcast is for informational and entertainment purposes only and reflects our personal opinions and experiences. It should not be considered legal or financial advice.
We make no guarantees regarding accuracy, timelines, or results. We always recommend consulting with licensed professionals and doing your own research before making any real estate decisions.